From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, payrolls signal the all clear, the Fed teeing up a faster taper, and markets pricing in rate hikes. We begin with the big issue, December 15th.
Jay Powell saying it's time for them to exit the market.
Overall, a strong report.
There's no ambiguity.
It does raise the stakes for the December meeting.
The Fed has a window to move, and obviously they're going to take advantage of it.
That's going to be the driver into December 15th.
That process of turning the shift and pivoting is indeed underway.
It is a more hawkish Fed than what the chair signaled.
We've heard a number of Fed officials essentially reflect this pivot.
The Fed needs to exit this QE business.
Look at how markets are now priced for next year.
The market has pulled these rate hikes earlier.
If you are late, you risk making a policy mistake.
There's clearly more pressure on the Fed to act now.
There is a window to avoid it, but the Fed is going to have to be very smart.
The next step will be at the December FOMC meeting.
Awesome lineup to round out the week. Joining us now is JP Morgan's Bob Michele, Manulife's Francis Donald, and Krishna Memani of Lafayette College. Let's start with this payrolls report, get some reaction from all three of you, then we'll work our way towards that Federal Reserve decision. Francis, first to you. Your reaction to that November payrolls report?
There's only one number I care about in almost any jobs report from now through to 2022, barring, of course, some big Sigma event, and that's labor force participation rate. This is one of the most important economic data points over the next 6 months, because if we can finally get some labor supply back into this economy, we'll see less of that wage pressure, less of that inflationary concern, and we can actually start growing this economy and seeing a less dysfunctional jobs market. So today's report, I know the headline wasn't good, and there's a lot of discussions about the underlying component, but this is good news because we're finally seeing that labor force participation rate number rise. And I'm telling you, in the next 3-4 months, it's that number that's going to be far more important to the outlook, to the Fed, and to markets than just generally whether we're missing or overrun by about 100K.
Bob Michele, your take, sir.
Terrific report. Francis is right. The participation rate is up. Weekly hours are up, and the unemployment rate is down. You marry that with the ISM services index that came out, and what that showed is the respondents were saying there's still a lot of labor shortages, and by the way, business is as good as it's ever been. This is a very healthy economy.
ISM with a 69 handle, just unreal stuff. Krishna, your reaction, sir?
Well, so I think both Bob and Francis are making the right point, which is the economy is in fantastic shape right now, and I think the key word is right now. And participation rate is really going to be the most critical thing, not just from an inflationary perspective, but more importantly from what the Fed decides to do and in terms of raising rates rather than just tapering. So I think that's really the key number. But I think Francis may be a little too early in declaring victory with respect to participation rate. With all the things that are going on with the virus, I think just looking at one number and saying that that issue has gone away, I think it may be a little premature.
Francis Donald, I'll let you respond to that.
Oh, yeah, certainly not saying that we are there. And actually, Krishna, I agree with you. So much of what we're talking about is a mark to market. The economy now is very good. Little bits of improvement in that labor force participation rate, but I'm still worried about the first half of 2022. And even though we're going to have a Fed that says right now everything is looking good, I agree with Bob. Right now, the economy looks real darn great. When we go into the first half of 2022, we're going to have lower PMIs, drag from China, fiscal drag, less income support that lowers retail sales activity. That's going to be really problematic. Even if we see around the margin some of this improvements in the structural elements like labor force participation rate, we still have this really big pothole to get through in the first half of the year.
So this takes us straight to December 15th and this Federal Reserve decision. Bob, in your mind, how much distance is there? How much daylight is there between the conversation about a faster taper and liftoff, that first rate hike?
A couple months at most. Listen, I think this past week has been a gift to Powell and the Fed because it's highlighted that the market's concerned that they're making two policy errors, near term and longer term. The near term policy error the market's concerned about is they're accelerating tapering right as a very transmissible variant of the virus starts to spread. That doesn't seem to make a lot of sense. And I think the longer term concern is the deceleration next year that Francis talks about. That's when you're going to start hiking rates. I think the Fed will address both of those. I'm pretty confident, and we're taking the other side of both of those arguments.
Well, what are the risks around the Omicron variant? Let's talk about how Omicron dependent this Fed decision actually is. We caught up with Ellen Zentner of Morgan Stanley. Take a listen to what she had to say it could mean for interest rates.
Risks around Omicron is that the Fed has to hike earlier, not later. And that's because you have sort of another supply shock compounding on top of the current supply shock, which creates even higher inflationary pressures that last for longer. That would be your worst case scenario with Omicron, right? And that's a Fed that actually has to hike earlier.
Bob Michael, the risk here is that they have to hike earlier, not later. Do you agree with that?
Congress is not going to like that, because Ellen may be right that one way to slow inflation down is to raise the cost of funding and borrowing and kill aggregate final demand, which is basically the consumer. So you're telling the consumer prices have gone up, but it's going to cost you a lot more money to buy that house or to carry that credit card debt or to finance your auto. Congress is not going to like that.
Krishna, they might not like it, but it's not about that. It's not about what we think they should do. It's about what you think they will do. What do you think they will do, Krishna?
Well, so I think let's talk about the taper first. That's already in the bag. That is, they're going down the path of faster taper, irrespective of what we find out about the virus variant. So that's one. From that point on to actually raising rates, we have a few months, and we will know a lot more in that in those few months. The problem with the thesis that Ellen is putting out is the fact that in the current environment, you can paint any picture with a very credible set of arguments. The problem is we don't know enough. So yes, it could be a situation where the Fed is actually forced to tighten faster because inflation is picking up. But maybe we find out that the virus really isn't as bad as we thought. So the issue that the markets have to face is they don't know enough, and they just have to wait. In the interim, the risk of a policy error on both sides is increasing, and therefore volatility is probably going to go higher rather than lower.
And the yield curve is going flatter. At the front end, about 60 basis points. At the long end, we've got a bid. Yields are lower by 7 basis points on 10s to 137. This is a conversation about going from the taper quicker to the first rate hike liftoff. And then from there, how high can they take it? I think that's what we need to discuss now. This is what Mohamed Al-Erian had to say on that. Take a listen.
When you start late, at some point, developments on the ground force you to go faster than you would normally want to go. And if you go faster than you normally want to go, you risk breaking something. And that's the problem of a highly leveraged economy, is that if you are late, you risk making a policy mistake.
Let's talk about how much work we need to do here. Francis Donald, we have a deeply negative real interest rate in America. There's a conversation about how far the Fed funds rate can go. The talk is 175. Others think they'll need to go higher. That's an important conversation we need to have now, Francis, not just lift off. It's about how steep that rate path will be. Can you draw any conclusions on that just yet?
Well, here's my issue. How far we're going to go is a reflection of how strong our economy can actually reaccelerate. And this is why Omicron was such a big deal, just from a larger philosophical standpoint. We probably need to move away from this idea that we're going through one-off shocks, just like a natural disaster or a forest fire. This is how we've been treating the virus, to the concept that endemic COVID is actually more of a smaller but semi-permanent shock that reduces our potential over the long run. And if that's the case, if we have 3, 4, 5 years of this rolling epidemic, and I don't know, but this is a scenario we need to monitor, then we're looking at a higher potential growth rate in our economy. And that limits just how much we can, how quickly we can withdraw and how far we're going to be able to go.
Inflation at 6, Bob Michael, pushing 7, if the median estimate is anything to go by for CPI next Friday. We have, and I'll repeat it, a deeply negative real rate in America. And Bob, the conversation people are having, and you're familiar with it, how much tightening do we need to see to actually see tighter policy? How much work do we need to do down at the Federal Reserve?
So I think that's the right question. The amount of negative real yield across the market. And in our view, the Fed needs to get to 2%. And hopefully they'll get there over the next 18 to 24 months, get to a zero real yield on the Fed funds rate and pause there. I think there's a much bigger issue here. And the issue we're talking about is that all of us have lived through the high inflation of the 1970s. All of us have lived through the disinflation of the last 30 years, but none of us, including the policymakers, have actually lived through financial repression. And that's what we're all struggling with. That's why things don't make sense to us anymore. And maybe it's something we should have picked up earlier. Certainly when I was in London for 10 years, starting in 2000, 2001, I saw the inversion of the yield curve. I saw what happened between 10s and 30s and now out to 50s when the government mandates that plans have to buy long duration securities. And I think that's the great struggle ahead, financial repression.
Krishna, final word on that before we move on. Final word to you, sir.
Well, so I think the how far we have to go in terms of tightening really depends on what your views are with respect to what the growth rate is going to be towards the end of 2022. And I think on that front, Francis made an interesting point, which is fiscal impulse is going to slow down and slow down meaningfully. China is going to slow down. We already see that. In the context of both of those drivers, growth rate and therefore inflationary pressures are probably going to ease. The real question on that front is, does the virus and the pandemic kind of complicates that and makes the Fed's job much tougher? I would bet that we probably see enough slowdown in inflation, enough slowdown in growth, where they don't have to do too much. But Bob's right, 2% is not that unrealistic an expectation. But it wouldn't be 4 times, 5 times in a year kind of a growth path or a tightening path that some people may be articulating.
We'll see. Krishna, Bob, Francis, sticking with us. Your yield curve, 79 basis points as we closed out 2020. Right now, 77, pushing 78. That curve is flatter, 2s out to 10s. Up next on the programme, the auction block, surging volatility forcing issuers to the sidelines. That conversation next from New York. This is Bloomberg. Live from New York, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block where we kick things off over in Europe. Increasing volatility, limiting issuance this week. Total sales nearing 4 billion euros, missing even the lowest end of trader estimates. An even quieter week for junk bond issuance in the US with just a single offering from Starwood Property raising close to $400 million. And US high-grade issuance holding up despite multiple days with no deals. An offering from Daimler pushing weekly volume close to $26 billion. Sticking with credit, earlier this week, JP Morgan's Bob Michele saying ditch government bonds and get back in to corporate credit.
This is an opportunity to get rid of any remaining government bonds you have and then go back into the credit markets, go back into investment grade and high yield. Yeah, there may be some headwinds from the Omicron variant. We'll see over the next couple weeks and couple of months. But for now, corporate profitability looks pretty good. I want to be a part of that.
Bob never left. He's still with us alongside Francis Donald and Krishna Memani. Bob, let's work on that. Give me the why. Build on that, the why. When you've got a rally on the screen like the one we've got right now in Treasuries at the long end. Bob, why rotate out of that and get back into credit?
I'm going to take a page from Francis's book here. I'm going to say 3 hours ago, it looked good. Maybe 3 hours from now, those comments will still look good. Look, if you're looking at government bonds today, from where they were the day before Thanksgiving, they're down 25 to 30 basis points in the long end. Look at credit. Look at investment grade credit. It's exactly the same yield today as it was before Thanksgiving. High yield is up about 20 basis points in yield today from where it was pre-Thanksgiving. I think there's good value there. Again, I look at ISM services. Corporate profitability is really good. Company profits will look great into and through next year.
Bob, you know how this works. People get greedy. They say, come on, Bob, 350 over. 350 is the spread right now. I want more than 20 widening. I want another 50. I want to wait around. Let's get back to 500. This could shake out like December 2018 again. Why is that greedy, Bob?
I think it's greedy because going into December 2018, the probability of recession had risen a lot thanks to the trade wars that were raging at the time. This time, it's difficult to see a recession out there. And every time you have a recession, that's when you get the real blowout in credit spreads. if you don't have a recession, then backups in credit spreads are a buying opportunity. I think that's what we're seeing now.
The difference between now and then again, the Federal Reserve managed to engineer a massive pivot. They could do that because inflation was in and around 2%. It is different this time with inflation in and around 6%. Take a listen to what PGIM's Greg Peters had to say about how durable the so-called Fed put might be this time around.
Is there still a Fed put in play, so on and so forth? And I think that is the question on the table. If, in fact, this is a worse situation than, let's say, initially believed, then there's not a lot of wiggle room, both on the central bank side and on the fiscal side. I'm not convinced that there is this quote-unquote put. I don't think it's very durable at all.
Francis Donald, how durable is the so-called Fed put?
I think it exists. I think we're going to have to live in this policy mistake land, for lack of a better term, yield curves flattening, some concern that the Fed's going too fast, until we see a policy pivot. So I am renting all of those policy mistake type trades. But in the first half of the 2022, we're going to have enough deceleration in inflation and soft enough growth to allow the Fed to pivot and see that re-steepening of curves. So I do believe it's going to come. But once again, we're in a position where we have to predict, when will people change their mind? First, they're going to need a lot of data, a mosaic of data that looks soft enough for them to do it. We're probably not going to get that until late in Q1 2022. So we're in this policy mistake environment just until then. But yes, I still believe in the policy put. It just doesn't always come when you want it to.
Krishna, your view, sir.
Well, so let me first address the points that Bob was raising. So the key point with respect to credit is really not whether the scenario that he's articulating will unfold. It could certainly unfold, and we could certainly have a much more steadier environment than some of us are fearful about. But the problem with credit today is the risk reward is just very, very skewed. So your best case is you make the carry, at least for any reasonable time frame. And then the worst case is we get into a recession and you have a 20, 30 point correction in the high yield market. That's really what the problem is. So if you wanted to make the bet that Bob is articulating, you're better off making that bet with equities rather than credit. I would say that there's a better case for long bonds than there is for credit today. I think a barbell of long bond and equities probably is a better outcome, meaningfully better risk reward than credit today.
Bob Michael, that is completely the opposite of what you believe, isn't it?
Look, you can only say that there's asymmetric risk in the bond market. If everything goes well, you get the interest plus you get the principal back. And if it doesn't, it defaults and you lose everything. So I get that. In a recession, default rates are going to go up. I don't think there's one on the horizon either next year or 3 years from now. I think the economy's in pretty good shape. And for Krishna liking equities, I can see from his perspective. But Krishna, think about this. You can't like the bottom of the capital structure unless you like the top of the capital structure. And if you like the bottom of the capital structure, then credit looks dandy.
Krishna, final word.
Well, so you like the bottom of the capital structure because it can go up a lot. The top of the capital structure just can't tighten much. That's what the problem is. It's just a question of not whether your scenario will unfold or not. The question is the risk reward proportional? That's the problem with credit today.
Krishna, I know a man at JP Morgan with some long bonds to sell. I'm going to find them for you and take a fee, OK? Krishna Memani is going to stick with us alongside Bob Michael and Francis Donald. Coming up on the programme, still ahead, the final spread, the week ahead, featuring a host of global rate decisions and another big inflation print right here in the United States. From New York, this is Bloomberg. Live from New York, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, a ton of central bank decisions. Decisions from Australia, Brazil, Canada and India. Initial jobless claims, and Minneapolis Fed President Neil Kashkari will be speaking later in the week. Not sure about that date, actually, for Neil Kashkari. We'll come back to that. Rounding out the week with US CPI plus another closely watched inflation print as well. Your Treasury market peaked out on your 10-year yield at 177 in the first quarter of this year. In the middle of the year, we heard from Francis Donald, who made this call.
My view here is that we've already seen the peak in yields. We're going to see fiscal disappointment. That we hit peak macro is not a surprise. Anyone who can do year-over-year, quarter-over-quarter comps knew this was going to happen. What was a surprise was how tight Chinese policy was, how quickly the big pie in the sky fiscal game changer change, and this Delta variant, which creates this uncertainty band around all of it.
Francis Donald, how comfortable are you with that call with 1 month to go?
Feeling pretty good right now about it, but of course there's a lot of surprises that can happen till year end, and I would really focus on the global component of this. We've spent this half hour talking about the U.S., but a lot of what happens to yields is also going to be a function of views we get from other global central bankers and from China as well. Right now, what really weighs on me is these ongoing waves, these various supply side shocks, and how they are going to give us slightly higher inflation than what I had expected, even at the time of that bold call.
One heck of a call earlier this year, and it's still looking good. In and around 140 at the time you made it, and right now in and around 140 as well. I can confirm that Minneapolis Fed President Neil Kashkari is scheduled to speak next week. But of course, as you know, it is the blackout period for the Fed to talk about monetary policy. I want to turn to the rapid fire round. 3 quick questions, 3 quick answers if we can. Let's start right here. Faster taper announced in December. Just a quick yes or no. This is an easy one. Francis, first to you. Yes or no?
No.
Bob Michael. OK, I thought that would be a straight up yes. Bob Michael, faster taper announced in December. Yes or no?
The ship has sailed, yes.
Krishna?
Yes. Emphatic yes.
Next question. Here's the split. Fed funds, does it peak below or above 175? Above or below 175? Bob?
Above.
Francis?
Still below.
Krishna?
Above.
That split is going to be important for risk assets. And this final one for you. Treasury yields above or below 2% by the time we get to the end of next year. Above or below 2%. Francis?
Below.
Krishna?
Below.
Bob?
They'll wave goodbye to 2% the first half of the year. Above.
Interesting. Had a feeling you might go there, Bob. Guys, what a great lineup to close out the week. Thank you, Bob Michael, Francis Donald, Krishna Memani from New York City. This was Bloomberg Real Yield. Thank you for choosing Bloomberg TV. We'll see you same time, same place next week.